This is episode 19 of Real Estate Real Fast. I'm your host, Aaron Jistel. A little bit about me for those tuning in for the first time. So I am the broker, one of the co-founders here at ListingSpark. ListingSpark is a technology-driven real estate brokerage. We help people sell their homes quickly, easily, safely, save them a ton of money in the process on commissions. We put together this podcast just to be a way to talk shop on any and every topic you could come across in real estate. We usually put an emphasis on real estate investment, especially residential real estate investment. That's who our core business kind of made of. The majority of our business is home builders, home flippers, real estate investors. And so we want to push out really good content that's going to be relative to that demographic, but is also going to be easily digestible for anybody that is interested in learning about real estate in general. And so today we're going to get a little bit away from the residential side of the real estate world and talk a little bit about what's going on in the banking industry, how that's affecting commercial real estate, and then ultimately pulling that full circle and talking about how that could trickle down and affect the residential real estate market. So to jump right into it, I'm sure everybody's been watching the news. You guys have heard about what happened with Silicon Valley Bank. They were a top 20 bank. I think they were the 16th largest bank in the country, and they recently failed. Signature Bank was shortly after them. They were also a more investment-centric bank. So for those of you that don't know about Silicon Valley Bank, I think you hear that name, Silicon Valley, and you think tech and startups and that kind of ecosystem, and that is largely correct. But a lot of people don't understand exactly what Silicon Valley Bank did or who they served. I think most people immediately err to the side of there's just a bunch of rich people's money in that bank, venture capitalists and other wealthy people, and that's really not actually the case. So Silicon Valley Bank, they did hold accounts for venture capital funds. I think what a lot of people don't realize, though, is venture capital funds are, yes, made up of wealthy people's money that they're investing, but it can also be pension plans, retirement funds. I mean, all kinds of different investment vehicles are investing with venture capitalists, and when those funds become compromised, that negatively affects everybody. But also Silicon Valley Bank catered towards startup companies. So companies that had recently received venture capital backing and were trying to launch new products, they would bank with Silicon Valley Bank because they were very well tied into that kind of startup Silicon Valley ecosystem. And so when the bank went under, why that was scared all these companies and why that had more effects on the little guy than you might have imagined was, imagine you're a startup and all your funds get locked up and you can't make payroll and you have 50, 100 employees that aren't getting paid, or you don't know how they're going to get paid. You're only FDIC insured up to $250K. Some of these companies had millions upon millions of dollars with Silicon Valley Bank. So this affected a lot more people than just some rich guys from Silicon Valley. I mean, it really spilled over, especially, Austin is a very tech-driven environment. And so there was a lot of local Austin companies that banked with Silicon Valley Bank as well. Ojo was one of them. That's a pretty prominent Austin startup here. Yeah, so it was scary times if you're a company that was banking with them. A lot of people don't know why exactly Silicon Valley Bank failed. So compared to other banks, they had a very different strategy on how they ran their bank. So yes, they worked with venture capitalist firms, and yes, they worked with startups. One of their products that they would do is they would do what was called venture debt. So they would take a company that had recently gotten venture-backed funding, and on top of their VC money they would get, Silicon Valley Bank would do a venture debt round, which is essentially a loan. Part of that loan would include warrants on the company that could be convertible into equity. So let's say that company hit big and IPO'd and became $1 billion company. They would have more upside to capitalize on that than just the interest on a loan. So the pros were that, as a bank, they could hit big on the winners and catch the upside, but the downside is venture debt is risky. I mean, a lot of these startups don't make it, and so those loans don't get repaid. And what's different than other kinds of venture debt is that let's say you go to a fund that's full of LPs or limited partners that pool money in to invest. those are individuals that have a very different risk tolerance than your average person. They know what they're doing is high risk, high reward. The difference, though, at Silicon Valley Bank is they were using customer deposits to issue these venture debt loans. I don't know if everybody that banked with Silicon Valley Bank knew that was the case. And so, they were putting out pretty risky loans to companies that may or may not have made it. So that was one part of their portfolio. They also invested in kind of long tail bonds that take a really long time to mature, even though they've got companies that can't always continue making deposits. Again, this is the startup world. So, when the market contracted the end of last year and into this year, a lot less companies were getting funded. So that means their deposits were down. Revenue was down. So money wasn't circulating into those accounts the same way. And so you take a combination of venture debt, long-term treasury bonds, and then being in a liquidity crunch. And that was kind of the downfall of Silicon Valley Bank. And then what it ultimately ended up happening is, the CEO came out with some statements that they were looking to raise some liquidity and potentially sell some of their stock to raise money. And that led to a lot of fear and a lot of panic, and then ultimately a run on the banks. So everybody went to go pull their money out of the bank. They felt like this is an unsafe environment for us to keep our money. And then they didn't have enough liquid assets in that bank to be able to field those deposits or field those withdrawals from their customers. And ultimately that led to the Fed stepping in. Assets were frozen. And for a while, it was really dicey on what was going to happen to those customers of Silicon Valley Bank. The Fed insures FDIC insures up to $250K. Well, if you're a company that has $10 million in that bank and, $250K isn't going to do very much for you. Now, since then, the Fed did step in. There was a backstop. They have since been acquired by First Citizens Bank and Trust. And so the at least for now, all of the customers of that bank seem to be okay. Similar thing happened with Signature Bank. And so the spillover to that was anybody that was banking, or not anybody, but a lot of people that were banking with smaller banks, smaller local banks, started to wonder, is this a risk? Is this something that can happen to me? I don't think anybody really thinks when they're working with a bank, what's on that bank's balance sheets? What kind of loans are they doing? How much liquidity do they have? You just think, I'm with a reputable bank. I put my money here. My money's safe. They're keeping my money safe and they're investing wisely. And I think that put a lot of that in doubt, especially, again, 16th largest bank in the nation, and they seemingly go bust overnight. So we are seeing a lot of smaller banks losing customers and moving their money over to Chase, Wells, Bank of America, banks where there's just not nearly as much of a fear of these kind of issues happening. And I think everybody just has this sentiment that if your bank is big enough, you're too big to fail. And so by moving their money over to a bigger bank, it's somehow going to be safer. So let's kind of talk shop on why that's scary in general for the entire banking system, but especially on the commercial market and even into the residential market. So the problem with this is a lot of these local banks create loan products that cater to construction loans. They cater to commercial real estate holdings. And that is tightening up significantly right now. So it's estimated that local banks, local community banks, hold over $2.3 trillion in commercial real estate debt. That's a just absolutely massive number. And where we are in the state of that debt right now is it's estimated that about 17% of all U.S. office stock, so commercial office buildings loans, are maturing this year. And why that's important is because in the past, if you had a commercial loan and it was maturing, you had a lot of different options. You could refinance, you could renew. Companies were making a lot more money. Maybe they just pay off that loan completely. And a lot has changed in 2023 compared to where we were in the past. So So everybody kind of knows what happens when a loan matures. So unlike residential real estate where you get a 30-year mortgage and it's on the same amortization schedule and you pay a fixed monthly payment, your interest rate doesn't change. Most commercial loans are not that way. So they may be on a longer amortization schedule. So let's say it's a 20 or a 25-year AM, but it's got a 5 to 7 year balloon. So you've got to do something within that 5 to 7 year period, or else your loan matures, it's due. It's a forcing function for that note holder to do something. And so, like I said, in the past, you'd either work out a renewal with that bank, and then that renewal will be based on where kind of current par rates are, or you would refinance completely and move that into a different loan product. So you pay it off. And that was a non-issue for about the past 12 years. So we were in a very favorable rate environment. Property values were consistently climbing year over year over year. So it's not a problem to refinance a property that has positive equity and it has appreciated since you took out your loan. We're in a really bad rate environment. Interest rates have essentially doubled, and occupancy rates are falling at a pretty alarming rate in commercial real estate space. And that happens for a lot of different reasons. It happens when leases come due and companies decide not to renew. They just feel like they don't need as big of a space. They want to go from maybe a class A to a class B to get something more affordable. They want their employees to work from home. They downsize. There's mass layoffs. You look at everything happening with some of these big tech companies, between Apple and Amazon and Dell and we recently had here in Austin, Indeed laid off like 2,200 people, not just in the Austin branch, but for the company wide, which made up, I believe, about 15% of that company. So when you have these massive layoffs that are happening, you have these huge office spaces that become available, and they either become vacant sublease spaces. Companies don't renew them when their turn is up. But ultimately what that's leading to is lower occupancy rates for these buildings. The value of commercial real estate is different than residential real estate, where it's based on income. What is that building generating from an income perspective? And then that's what ultimately translates into the value of that building. So if occupancy rates fall and the owner of that building is collecting less rent, the value of that building is coming down. And then you have rates that are climbing, in a lot of cases doubling or even tripling. So those financing options from these local banks are either disappearing completely, they're just off the table, because right now in the banking environment that we're in, everything is tightening up, or the new terms on a new loan are just not tenable for that owner. They either require too much additional cash to put down to meet the equity requirements, or the capitalization rate is too low or even negative, and you can refinance and you're still taking a loss. So it becomes very, very problematic. Ultimately, what it can do is it can lead to higher default rates. So as of right now, our current commercial default rate is at 3.2%. Which is a pretty big increase from where we were in the last couple of years. So it was under 1% last year, and it had been under 1% even up into the pandemic. So to be at 3.2% now is a little bit, that's pretty alarming. It's climbing at a pretty fast rate. Just to put it in perspective, in 2009 and 2010, so on the tail end of the housing crash, commercial occupancy rate delinquency rate was floating between 8 and 9%. So, it's not crazy to think that it could climb to be that high with options for loans and refinancing tightening up the way it is, and then occupancy rates falling the way they are. So it is absolutely something that we need to keep an eye on, because frankly, it's pretty scary what's going on. So if default rates start to climb the way they did before, what ends up happening is it's going to hit those banks first. Those banks are going to have the strain of foreclosing, taking over those properties, managing those properties. getting them off their books, which usually means selling them for a pretty significant loss. And then that ultimately then trickles down to the rest of the economy. So let's talk a little bit about what that means. By the way, before I kind of get into the next section, anybody that's tuning in live, feel free to chat in. I do have the chat open, so I'm reading it. If I don't get to it right away, we'll certainly save some time for some Q&A at the end. So if you guys have anything you want to talk about or chat in, feel free. So let's talk about kind of what the exposure, what the fallout is for the residential real estate world. So small banks, they don't just lend on commercial. They also issue loans for residential or multifamily properties. They're creating loan products for new construction. So it's not just the commercial world that gets affected when there's this kind of turmoil and uncertainty in the banking world. So the other thing is small banks create loan products for investors that are doing fix and flips or buy and holds and things like that. So Derek, who was our guest on last time, talked about that at length, about how he started flipping properties and he was getting hard money, or he had, one-off partnerships where he was having to give up a larger percentage of interest or kind of equity in the deals. And then over time, with a proven track record, he was able to go to a local bank, and he was really able to create a great relationship with that bank and give him much better terms on a line of credit. So those are things that when we're in a really good economy and a really good rate environment, those products become available to a lot more people, which just makes options more readily available for seasoned investors or anybody that's got a proven track record of success. So when we see the rate environment change and we see the banking environment change, a lot of those products just start to go away. They start to tighten up. And so that's something that we really have to keep an eye on as it trickles down in the commercial or into the residential world. So also commercial or multifamily products with construction loans, ultimately those have to refinance. So construction, a lot of time construction loans are going to come from a smaller bank. They might be hard money. Those are short-term loans. They have to have an exit strategy on that loan for it to be a viable product. So, the goal is just get enough financing to pay for the different phases of construction or the acquisition costs of a multifamily and potentially the renovations to get the value up and get occupancy rate up. And then in order for those products to actually work, the goal is there has to be an exit out of them. So they may be a 6, a 12, a 24-month term, but ultimately there has to be long-term financing that comes at the end of that. And so when those loan products change or disappear altogether, you end up with a lot of people that are holding these short-term loans that are stuck in an awkward situation because they just can't get out of them the way they could have in years past. So again, something that we really need to keep an eye on. I'm going to talk a little bit about what my advice is if you're either stuck in this situation or you're thinking about, man, I've got these projects that I'm looking to build and I'm working on obtaining financing. Candidly, I'm not a banking expert. I do a lot of research on this stuff to stay as informed as I can, but I am definitely not a banking expert. So I certainly recommend finding in your network people that are going to be able to talk intelligently about different loan products. You can always reach out to us and we can usually point you in the right direction. So full disclosure. Okay, let's talk a little bit more about how the commercial market historically correlates with the residential real estate market. So a lot of times commercial is a leading indicator of what's going to happen to residential. In a normal market, they're pretty closely tied, meaning when the commercial market is up or commercial space, offices are in high demand, usually that means the residential market is also in high demand in those same areas. So if an office full of companies or full of employees means jobs mean people need housing. And so you'll even see residential markets following new commercial developments. So if you're in a big major market, you have a new big giant development, whether that's an open air mall, whether it's Samsung building a new campus, whatever, residential is going to follow that because they know housing usually goes along with a strong and rich commercial market. And so when we start to see those things change, they usually go up together and they usually go down together. COVID has changed things a little bit. And there is still a correlation there, but it just doesn't follow the same way it would have in years past because just geography has changed for businesses. People are working from home more than they were in the past. So the pool of employees that you can hire expands to the entire country rather than the local market that you're in. So, it's not necessarily fundamentally tied to everybody has to live and be right near their office. I think that's going to start changing a little bit more. I think a lot of companies that said they would never go fully back into the office are already starting to walk back on that. We're starting to see some companies pull their employees back in the office. So I think it's going to be interesting to see how that plays out long term. But for the most part, huge companies like Dell, Facebook, Apple, I mean, these companies have always had massive office spaces. They're letting some of those office spaces go. They still have a big portion of their business working from home. So we don't necessarily see that right now the residential markets are going to exactly follow the commercial markets. But anytime that you have higher occupancy rates as a result of layoffs and companies either going under completely or downsizing, ultimately job loss, unemployment rates, as those climb, the residential markets are negatively affected by those as well. So, my notes and my thoughts on the whole situation is a collapse in the commercial real estate market is, it obviously is not going to be a good thing for the economy. It's going to have some pretty significant negative effects on the economy as a whole, which has to ultimately trickle down to the residential markets, in my opinion. It's going to mean job loss, market turmoil, uncertainty. It creates swings in the stock market, negatively affects what's in people's 401ks and bank accounts, and their personal liquidity and what they're willing to invest in. The second home market probably starts to take a big hit before the primary home market is what we've seen in years past. We're already kind of seeing that in the world of Airbnbs, that we're seeing occupancy changing. People are just thinking twice about going on those vacations. But with all that said, there's still a lot of money that's circulating in the U.S. economy. It needs to be invested somewhere. So I do think there's a world in which if we see a sharp decline in the commercial market, that could lead to more investment dollars that are funneling over into the housing sector. So, we have a ton of domestic and international funds that need to invest those funds somewhere. Multi-billion-dollar hedge funds or private equity that, if they don't invest that money, those partners or whoever's putting their money into those funds is going to find a way to pull that money out and invest it somewhere else. So that money has to go somewhere. Real estate historically is one of the safest asset classes to invest in. And so it wouldn't surprise me if commercial real estate starts to go sideways if we start to see more investments in single family or multifamily real estate. Overall, I'm very nervous about the commercial real estate market. I think we're going to have to see some kind of a backstop with the banks to give them flexibility to work with the owners of these buildings, to give them viable financing options. Without that, it's, you could largely start seeing that the highest percentage of commercial owners in a city are banks. If we get to the point where these loans mature, so 17% of loans mature this year, more years to follow. And if we don't figure out a way to solve this problem, and the banks start taking these properties back, these banks then have to carry these properties on their balance sheet. They want to get them off as fast as possible. They don't want to be in the commercial landlord business or even be in the property ownership business. So they're fire selling at a loss. That's pulling values of other commercial real estate down simultaneously. That would obviously be worst case scenario for the commercial real estate market. I don't think we're going to get there. I think we are going to see some kind of a financial backstop that's going to make sure these banks have the tools that they need to work with these owners and create more long-term financing options that are going to keep them from losing these to foreclosure. This could even be the forcing function that gets the refinancing options start to get better, money gets a little bit cheaper. So this could be what finally gets the Fed to lower rates. They just hiked 25 basis points the last meeting. I think a lot of people thought they may either stay put. Some people thought they might get a little bit more aggressive than a quarter of a point. Um, I think one could argue that that was just a way of kicking the can that didn't really help or hurt anything, and it just kind of kept everything that we're dealing with in limbo. I think it was a bit controversial for that raise uh, to happen right as we're having all this turmoil with the banks. So if we start to see a lot of defaults in commercial real estate, that could be, like I said, that forcing function that happens to ultimately pull rates back down for both commercial and residential loan products. So ultimately, my goal is not to create fear. I think we're in a weird time right now in both the commercial and the residential world. We're actually seeing a lot of signs of life in the residential world. So over here at ListingSpark, we are seeing an increase in showings, executed contracts, closings. If we're looking at March and February, kind of halfway through February is when we started to see the uptick. So I think we're getting a couple things. I think we're starting to see in the residential real estate world, people have just become more accustomed to where rates are sitting right now. They've been able to wrap their brains a little bit more around what that means for the type of financing they're going to get. We've started to understand better how we're going to negotiate these deals, whether that's working in seller credits to buy down interest rates. But I just think we went through this shock and awe phase in the second half of last year where nobody kind of knew what to do or what was going to happen. And now we've kind of come to this realization that this is the world that we're in right now. We may see rates fall at some point, but the world of kind of that 6.5, even floating up to 7% interest rate is a reality that people have to deal with. People still need to move. They still need to buy and sell homes. And so in my opinion, I think we're just getting a little bit more of the market, understanding the situation that we're in and starting to deal with it and grease the wheels and see a little bit of movement. I also think we are starting to get the seasonal uptick. March and April are historically the months that we start to see the market move a little bit more as we come out of the winter months. And so we're seeing positive headway in the residential real estate markets. I think we're seeing negative movement in the commercial real estate markets. So how those two kind of converge with each other here in the coming months is going to be really interesting and something that definitely you should keep an eye on. I think we want to come out of this without fear and panic, but from an educational standpoint, I think it's really important whether or not you're investing in residential or commercial to kind of understand what's happening and then react accordingly. So a little bit earlier in this, I kind of talked about what is some of my advice if you're stuck in this situation. Let's say you're building a house and that's going to be an investment property, and ultimately you've got to get into long-term financing. I would, if you already have a banking relationship, go talk to your banker. Make sure those products that you talked about are still available to you and they haven't fundamentally changed. Start building strong relationships with local banks that you're working with. They're still banks. They still have to deploy capital. They're still going to be on a risk basis, meaning they want to work with people that are going to give them the best chances of seeing a return on that investment. And so they're going to want to work with investors that have a solid track record. If that's you need to be able to have those relationships cultivated. So when you're working on your projects, you already know you have those relationships in place and you have hopefully those banking terms already in place. But the key here is being proactive and not reactive. So when you start to get in trouble and you need a miracle, it's really hard in the banking world to have that happen at the snap of a finger. A lot of these conversations need to be happening far in advance. So let's say you can see the writing on the wall and let's say you own some commercial real estate or you're in a situation where you got to refinance. You don't want to wait until the last minute when stuff is getting really dicey with you. You want to start opening up conversations and start working with your bank early on in the process so you can have that open line of communication. And I think banks are going to have to start getting creative with how they're going to deal with these maturing loans. I think there's an opportunity that we start to see a lot of new loan products that are going to come out of this. it was subprime loans that got us in the all of the trouble in '08, the last go around, and those went away, and a lot of their new banking products became available in the 2010s and where we are now. So I think out of this is going to come something new that's going to have to bridge this gap between where we're at now and where we need to get to. So having those communications with your local bank, I think, is really important. So that's all I got today. Hopefully that was helpful for you. I'm gonna give another couple seconds if anybody wants to chat in. If they have any questions, feel free. If you tuned in late and you missed any part of this, feel free to check us out on Apple Podcasts and Spotify. In general, if you have any real estate questions, you can reach out to us anytime. Go to ListingSpark.com. We've got several ways to get a hold of us. We're also all over social media. So hopefully you guys took away a little bit of value here. Tune in. Typically we like to go live Wednesdays at 1 o'clock. We're going to bring some good content to you. So give us a like, give us a follow, and thanks again for tuning in and joining us.